Hello, everyone. This is Tammy Chambless. I'm here again with another video on a strategy that I've been trading for the last 5 months or so, called MEIC, Multiple Entry Iron Condors. And I trade these on zero DTE SPX options. And I'm also going to cover a little bit about back testing. I always encourage people to do their own back testing, and because you can understand the trade better, how it works better, and you can make your own decisions about how you want to trade this. So what we will cover today is, let me get this working here. Just a second. There, whoops. Okay, what we will cover today is a little bit about what a zero DTE trade is. I always cover that in case anybody's new to these. I'll show you a little bit about what's been going on in the market recently. I'll show you the basics of this strategy and how to figure out how many contracts to trade, some issues with stops, and then I'll go into some things about backtesting and understanding backtesting results. So should be a good video for you. So let's see. Hope I'm not going to have this problem all the way through. There. So zero DTE, what is a zero DTE trade? It means 0 days to expiration. And you're trading options that expire that day, which means no overnight risk, which is one of the great advantages to this trade. And SPX is cash settled, so there's no risk of assignment. It has tax advantages. 60% of the profits are taxed at long-term rates and 40% taxed at the short-term rates. You can use XSP for smaller accounts. It's 1/10 the size of SPX, and it has the benefits of SPX, the tax benefits. The commissions on SPX are higher. There's an additional CBOE fee because they are the only exchange that offers these options. So there's an additional fee. But if you trade less than 10 contracts of XSP, there is no CBOE fee. So you can use SPY if you want, but there is a risk of assignment with SPY. And on these trades, this strategy I'm going to show you, you're going to be close to the money. So you'll need to close out your positions prior to the end of the day. And there may be some issues with your broker wanting to close out your trade. So that's an issue with these to be aware of. So why did I develop this, or why did I start working on a different strategy? I was trading my old zero DTE strategy, selling Delta 5 iron condors in the market last year, and it was working fine until late in the year. And things just started changing. The market, the intraday moves started becoming more and more, and I was increasingly getting stopped out at a higher rate than I had been prior, and it just seemed like something had changed. And then in January of 2020, I took about a 20% drawdown in my account, and that's a lot for me. I'm pretty conservative and I don't like drawdowns. So I paused my trading until I could do some further research. And what I found was basically because of the things going on, inflation was starting to rear its head in early 2022. There were coming interest rate increases in 2022. The war in Ukraine broke out in January, the increase in oil prices and other factors. And the intraday moves in the market were just greater than could be tolerated by my zero DTE Delta 5 strategy. So I looked for ways to trade with better results in this market. And here's some images. If you're a member of the Facebook group, you've seen these images on Facebook. But this top graph shows the daily point swings from high to low. And here's 2017. So you can see it's very low, very rare to get above a 1% move in 2017. 2018 was a choppy year, and early in the year and later in the year, we had some big moves, but most of the year it was kind of settled down again in 2019. And then 2020, of course, COVID hit, and then we kind of settled down a little bit. 2021 was pretty calm. And then late 2021 and then 2022, we've just consistently seen moves, 3, 4, even 5% moves intraday. That's a lot, and that's I think the market on the old Delta 5 strategy, usually it could absorb a 1% move possibly, but much more than that, you're going to get stopped out. So the second chart here is expected move. In the Facebook group, there was a lot of discussion about trading based on expected move. And I did this graph to show that might have been fine in 2017, 2019, it probably would have been fine. 2021, it worked pretty well, but 2022, it just seems like every day that the market is exceeding the expected move. And so there's another graph here that this shows the intraday moves that exceed the expected move in only 2022. So this is just 1 year of data. And you can see that the blue is any day the intraday move exceeded the expected move, and the black is any day that the intraday move did not exceed the expected move. So much greater moves than were expected. Now the expected move is calculated off of the volatility, and the volatility in 2022 was actually pretty low. And for those of you who haven't met him, here is my cat. He's wanting to get in on the action. So let me see if I can move him along. So anyway, you can see the expected move wasn't a good barometer. The volatility was not as high as you would have expected for the kind of moves we were getting. And so therefore expected moves were lower than normally would be indicated in this kind of market. And premiums were lower. Everything was just lower because of the volatility wasn't reacting the way it normally did. And there's a lot of reasons for that, and I'm still working on trying to understand why that is. Oops, here's so the strategy that I've been working on, and I did not originate this strategy. I have a couple of friends who really worked this out, and then I've started adopting it and just building on what work they did. I call the strategy MEIC, multiple entry iron condors. And the following information that I present in this presentation is the result of a lot of testing and working with others to find strategies that work and try different things. I've built on the work of others. This is a work in progress, so I'll probably learn things as I trade this more. I have live traded this since August 2022, so I've got about 5 months under my belt, and that is not a long time for any of y'all who have worked on new strategies. And this shows my research. You may find other things that will improve on this strategy or other ways to trade it. So I encourage you to do that. So the basic rules of the multiple entry iron condor are you enter multiple tranches on a regular interval using 0 DTE options on SPX. And I personally enter every 30 minutes starting at 12 Eastern time, and I enter 6 tranches. So I enter at 12, 12:31, 1:30, 2, and 2:30. So 6 tranches, and that essentially means 6 trades of however many contracts I'm trading. And I leg into an iron condor using put and call credit spread. So legging in, and I pretty much enter the puts or calls, and then the opposite uh, side within a couple of minutes. So I'm not trying to time the entries based on what the market's doing. I'm just trying to get in on a regular schedule and let what happen happen and let the probabilities play out. So I target a minimum credit of $1.25 on each side. So that's not for the total iron condor. That's $1.25 for the put side and $1.25 for the call side. I try to get those sides as close to each other as I can, and there's some things I'll talk about with that. The average credit that I get is usually around 150. uh, I try to stay as close to 125 as I can, but sometimes, there's maybe a trade at $1 and a trade at $1.40, and I'll take the trade at $1.40 if those are the two offerings. Then I sell from 25 to 30 wide point spread on each side, and I will vary the width to kind of control the credit I'm getting on each side in order to attempt to get a similar credit on each side. Some people do that and some people don't pay attention to that. That's fine. It's just how I trade it. And then an important point about this strategy compared to my old strategy, this one you want a 1x net loss. So you set the stop for 2 times the initial credit, and that will give you a 1x net loss on each side. And I do manage each side separately. I put a separate stop on the calls and a stop on the puts, manage them separately. So the idea is if one side stops out, the other side hopefully wins and you're break even. And you're just hoping for a few of these entries to win on both sides, and you've got a winning day. You start making money. And the there can be trades that stop out on both sides, and there can be trades that win on both sides. So, but we're relying on the probabilities of those options. So, if you're not familiar with iron condors, here's the basic risk graph. And where you sell, I'll use, let's say the stock price is at 3,900. I sell a 3,860 put, and I put a stop on it for a 1x net loss. Let's say I collect $1.25, which would be 125 credit on that spread. And then I set my stop, so my loss would be 125. Same thing on the call side. I might sell a 39.40 call and buy a 39.65 call and set the stop so that my loss is not greater than a 1x loss. So just some other basics to cover. Never risk more than 2% of your account in any one trading day. Now, if you have a small account, you may need to go over that and risk, 3 or 4%. But try to keep the risk as low as possible. And by risk, I calculate risk as if I lost on all trades that I put on in one day, I don't want that to be more than 2% of my account. So that's how I try to manage these. Sorry, that's Charlie, by the way, if I didn't say his name earlier. He's my trading buddy. Uh, and then the maximum net loss is using a stop of maximum net loss is 1 times the initial credit. So the stop is set for 2 times the initial credit, and the loss is a 1x loss. So if, let's say I have a $100,000 account and 2% of that is $2,000. So I set up the trade so that if I lose on all sides, on all trades on both sides, a 1x net loss will not exceed that $2,000. So if I get $1.50 or $150 credit on each side, that's $300 credit I'm making on the whole IC, but that's also my risk. And then I've entered let's say, one contract and 6 tranches, or I enter 6 times, but I use one contract each time, then my total at-risk amount is $1,800. And that is less than 2% of my account. So therefore, I'm okay. Now, that's not to say you need a $100,000 account. This is a general guideline. So if you have a smaller account, that's okay, but be aware if you take a loss on all sides, that loss is, just be aware of what that loss would be and make sure you're okay with that. Now, if you do have a smaller account, you can trade fewer than 6 tranches. That's what I trade. But you could choose to trade 3 or 4 tranches, and that's fine. And that would reduce your amount at risk and reduce. So you want to keep that less than 2 to say 3 or 4% of a small account. Then let's see, I'm getting lost here on something. Hold on. Okay, so if we were stopped out on one side only, that means, and we're using a 1x net stop, I'll call it that. That means we'll be at break even. So we're taking a 1x loss, we're winning a 1x win on the other side. That means essentially our winning side and our losing side cancel each other out, and we're at break even. If we stop out on both sides, we'll take a full 1x loss on the whole trade. And that's kind of worst case. If I call that a double stop, if you're stopped out of both puts and calls on the same trade. Now, the worst that could happen is you're stopped out on both sides on all trades. What this chart looks like is just looking at trades, a total number of trades, how many times in a back test from 2016 to 2022 using these trading rules did we take a double stop out. And so out of 9,712 trades, I'll point to that here. So we're stopped out about 2.5% of the time on both sides. So that's where we have losing trades on 230 trades. So in 2022, out of 2,600 trades, that was about 2.6% of the time, or 68 trades in 2022 that stopped out on both sides. Now, I will say this is back test, and we'll talk about that in a little bit. I'll say in live trading, because back tests are testing over a 1 minute period, it may miss some of the stop outs that you would have in live trading. So I would essentially double this. I would say 5% of the trades are going to stop out on both sides at any one time. That's generally what you can expect. It happens somewhat frequently. Some days are trending days and you'll stop out on every trade, but only on one side. Those end up being break-even days. If you stop out on all trades on one side, and then one of your trades you stop out on one additional trade on the other side, that starts to be a losing day. You're not losing much, you just stopped out on one additional trade. And if you win on both sides, you have a good day, and especially if you win on more of the trades winning on both sides. So this chart looks at trading days, not just trades. The last chart looked at individual trades. So on an individual day, and I just back tested the last 5 years here, I think that is maybe 4 years. And that's because I think the data is better on these later years than it was on the earlier years using these rules. So what number of trades, or percentage of trades down here at the bottom, did we have more than one trade stop out, or two trades or three trades stop out, having a double stop, and how many winners did we have? So out of these trading days, we had, and it says total trades, it should say winning days. So we had 401 winning days uh, over this period of time, and 113 losing days. But very rarely did we have, almost like one time or three times in this 4 year period did we have every trade on all day long stopped out on both sides, took a full loss. So many more days you'll have a few losses, a lot of days you'll have one loss out of, say, the six trades. Um, there's some days you have two trades that go against you, but the rest of the trades, based on this back test, are, very few have more than two or three stop outs. Whereas if you look at the winning side, there was a lot of trades that are break even. It's a trending day, you stop out all on one side, or you got a trend in the morning and it changes in the afternoon. You've got losses on the calls in the morning and losses on the puts in the afternoon. It's basically a 50-50 split. So, roughly half of the trades are stopped out. But if you look at this graph in the back test, 58% of the trades are profitable trades, profitable days. 16% of the days, trading days, are losing days, and 24% were break even days. So there's going to be a lot of days where you're just break even and you traded and you didn't make any money, but you didn't lose any money either. So now I had mentioned that in live trading, because of the data based on 1 minute trades, that there might be a difference. I looked at, I have traded this live since August. So I looked at the trading days since August, that I traded from August through December 2022. So I could see, am I getting similar results? Do I see the same kind of trends? And here, I think prior it was, let me flip back one, just a second. There, 58% were profitable days. In live trading, 43% were profitable days. Then 25% were losing days, and 31% were break-even days. So kind of similar results. It's not a very long period of time for live trading, and I would hope the longer I trade this, the more like the back test these results become, the more data you have. But this illustrates why this strategy is so profitable. You have very few days that you're taking big losses. You have many more days where you have a lot of winning trades. So, and you have a lot of days that are break even days too, to be honest. So, you got to be prepared for that. But in general, that's what you can expect, or that's what I've experienced in trading this. And I think we can expect that going forward, and to be closer to what that back test shows. Now, one thing that I mentioned earlier about the rules were entry times. If you recall, in my old strategy, I was entering at roughly right after the market opened, and I was trying to time my entries to when the market was going down, I'd enter calls, or when it was going up, I'd enter puts. This strategy is a little different. Excuse me. And I did some testing on entry times. It's probably the current market, but this strategy does not work as well entering in the morning. And I think in this market, there have been so many swings in the day. If you're familiar with what's going on every day, or have been watching the market every day, you'll notice there's often an opening swing that just completely reverses by a couple of hours after the market's open, and then we may reverse again in the afternoon. So it probably is because of that that the later entry times are working better than the earlier entry times. I suggest entering every 30 minutes. You can enter every 15 minutes. You could enter every 20 minutes. Choose whatever works best for you. And then, but know that as you enter this, and if you're entering every 30 minutes, as you get nearer the end of the day, and you're using a target credit like we are, your trade is going to be closer and closer to the money as the day progresses. It would be that way even if we were trading deltas, but for this strategy, credit target seems to test better than trading deltas. So just be aware that that's going to happen. It's going to feel like you're awfully close to the money, but you're still targeting a certain credit. So here are the performances of various entry times. And I listed the compound annual growth rate here, the max drawdown, and the CalMAR, which is a measure of risk adjusted returns, which takes into consideration the drawdown. So you could have a high CAR ratio and a high drawdown, such as this one, 14% CAR and a 9% max drawdown for that particular time, and your CalMAR is going to be lower than it will be if you have a high return and a low drawdown. You get a higher CalMAR. So I kind of like evaluating these by the CalMAR ratio. There's another measure you can use, Sortino. It's just my backtester doesn't calculate that. So this is what I'm using currently. And so for entry times, and these are all listed in Eastern time zone. So right 3 minutes after the market opens, that entry, you can see the win rates, loss rates, the number of trades in those time frames. And sometimes they're just not trades that will meet the credit target. So there may be more or less trades at a certain period of time. And in 2020, now that was for the wide range of dates from 2016 to 2022. As this chart on the right just looks at 2022 trades by entry time. So in general, you can see the win rate ranges from 56, 57% to 63, 64%. So that's about as good as it gets for the win rate for this. The compounded annual growth rate, notice how toward the afternoon, the returns are getting better versus returns in the morning or even kind of middle of the day. And then the max drawdown, you kind of run into some anomalies later in the day. It's lower earlier in the day, but some pretty good CalMAR ratios here. And you can use this to make your own decisions, but know that this is historical data and just what happened in the past. Not to say that things change in the market again and all of a sudden the mornings become more profitable. Like some people I've heard are entering this 930 trade because it's got very low drawdown, very high return. So that may be a good trade to enter. And then they're also entering later in the day. That's fine. So it's your decision when you want to enter based on what return you think you want to get. So the next step here, I always include something about stops. You always want to use a stop. There's too many trades on to trade without a stop on these. And I think a lot of you, if you've been trading some of my other strategies with zero DTE, you're used to me talking about stops. They're just so important for these trades. You want to keep your losses predictable and within a small range for the success of the strategy. So that if you trade this over a large number of trades, in general, the strategy should work. And if you let the losses become large by not using a stop, it completely throws the trade into an untenable trade. You won't make money on it. So always use a stop for this strategy using a stop of 2 times the initial credit. So for a market stop, that's fine to use. Occasionally you'll get a rogue price that'll stop you out at some absurd price because you have no control over what your orders fill at. But a market stop will get you out at some price. Now your trigger is once you hit 2 times the initial credit, and that would be a 1x net loss. But realize with the market stop, it will fill at whatever the market price is. So you don't have any control over that. I use a stop limit order, and that's where you set the price at which the stop triggers, and you set the maximum price or a limit that you're willing to pay to close. So I set the stop trigger for 2 times the initial credit, and I add 30 or 40 cents more to get to the limit price, just to give it room to move. You don't want to set the limit at the same price as the trigger because it will never fill. The market maker has to get paid for taking the other side of the trade. You've got to pay him at least a nickel. And on SPX trades, it's usually more a dime or 20 cents. But you've got to pay them something. So I usually take what the going spread is. If I'm looking on an option chain, the spread between the bid ask, and I double that for my distance between the trigger and the limit. And know that if prices start moving quickly, that spread gets wider, and that's why I give it a plenty of room to fill on these stop limit orders. Very often that will fill right at the 2 times the initial credit. Or sometimes under. The price may rebound a little bit and or revert a little bit, and I'll get a fill for under. Another way to set the stops is you can set it when the short leg hits a certain price, and you can estimate what price that's going to be by looking at an option chain. Look at what your current strike is, and then look for a strike that's going for 2 times more than that. And that tells you, using the current parameters and the current time frame, roughly how much the stock will move before it hits a 2x, before it becomes 2 times the initial credit. And that can give you an idea of where to set it on condition. Now, later in the day, that price is going to change because of decay. So you may be able to move your stop further out and further out, and set it on condition. But it takes a lot of management to set it on condition. Then a manual stop, you can set a price mentally at which you'll get out and enter a market order to exit. But I would say that is the worst performer. You can't move fast enough, faster than the market can move, and you won't be able to get out at a good price. I just guarantee it. And things can happen very quickly. So I just really recommend not using a manual stop. So let's see here. I use a stop limit, and I'll use an example of how I do it. Let's say I got $1.50 credit on the calls and $1.60 credit for the puts. I set the stop on the spread for $3, which is 2 times the initial credit on the calls, and I set that would be the stop at $3 and the limit at $3.30. So I use a 30-cent spread on the call side, and that's usually plenty. I use a 40-cent spread on the put side because puts can move faster than calls usually, and I just want to give it a little more room on the put side. So I'll set the stop on the put side for $3.20, which is 2 times the initial credit on the puts. Of 160 times 2 is $3.20, and then I'll add 40 cents. So on the put side, so my limit order on that stop limit order is $3.60.
Unknown caller.
And sorry about that. And then I set the stops on the spreads. because there are a lot of trades on and it gets difficult to manage when they start stopping out. So rather than setting the stop on the short leg, as I have done in the past, I set it on the spread just because it's easier to manage. You can still set it on the short. That's fine. I don't have a problem with that. But just make sure you can act fast enough to close those long legs once you get stopped out of the short, because those prices can change pretty quickly. But then, because I do set the stop on the spread, I know that toward the end of the day, as those long legs um, decay in value, they become worthless. And if I have a stop on a spread with a worthless option that nobody wants to buy, then I can't sell it. So I will change my stops toward the end of the day to just be on the short leg. And that's usually about an hour to hour and a half before the close. I watch when the long legs become uh, worth less than 5 cents. So usually it shows it as 2.5 cents. And that's the point where I start changing my stops to just be a stop on the short option. And don't use a stop limit order if you can't watch the market, because occasionally they will get blown through without filling. I used to use a 20-cent spread between the stop and the limit order. And on this trade, I traded for several months that way, and about once a week, I'd have a stop limit order get blown through. So that's why I increased the spread between the stop and the limit to 30 cents and 40 cents just to give me more room. And since I've done that about 2 months ago, I have not been, my stop has not been blown through. So, not to say it can't, because I fully expect it to happen at some point in the future, but it just hasn't happened yet. Now, let's look at some of the parameters. And this is where I would encourage you to do some back testing. And I'll show you some tools and techniques that'll be easy to do. But just to start off, let's look at varying some of the parameters of this trade. Like, what if we use a different stop? And for a lot of you who have been using setting stops at 3 times the initial credit, setting the stop at 2 times the initial credit and getting out at a 1x stop is going to seem like you're getting stopped out more. It just seems like you're going to get hit more. You will be hit more. So let's say, okay, I don't know if I like that. Let's do some back testing based on setting the stop uh, at a higher multiple, like a 3x multiple or a 2.5x multiple. And then how to I've said the entry times that I like trading at, but based on the chart, you may choose to trade at different entry times. How do those perform? And I'll show you how to backtest that. And another question, like $1.25 seems like a lot of credit. I'm pretty close to the money. What happens if I target, a lesser credit than $1.25 minimum? Or what happens if I target a higher credit than $1.25 minimum? How does that perform? So all of these are great questions, and they're curiosity drives a lot of my back testing. When I come up with a strategy or I hear about a strategy, then I start testing it and trying different things with it and seeing how it acts in back testing. And then I might live trade it for a while and see how it acts. And it gives me a lot of information about the trade as I'm doing this. And I think you become better traders if you do back testing. So I encourage you to learn how to back test and do some of your own back testing and make your own decisions about this. You may decide something different than I, and that's fine. So first, let's look at the size of the stops. Intuitively, you might think if you increase the stop multiple from a 1x net loss to a 1.5x net loss or 2x net loss, maybe you'll avoid some of those stop outs and have more wins, and maybe you'll make more money that way. So let's do some back testing to see if that's true. And I'll show you what this backtester is, but this backtester was set up specifically for this strategy. You can backtest a few other things, mostly I mean, it's usually iron condors, but you can do credit spreads on this. But this back tester was developed by a guy who was trading this strategy, and he's done a great job. But it is specific, so you can't test calendars or things like that with this back tester. But these are the results. So let's just start with the basic rules I gave you, which was a 1x net stop. That's the stop is 2 times the initial credit. So your loss is a 1x net loss. We call that a 1x net stop. And we're targeting $1.25 credit on each side of an iron condor. This should say 25 wide wings and a 1x net stop, entering 6 times or tranches every 30 minutes starting at 12 o'clock, and relying on the stop or taking to expiration. And I included slippage and commission just to make this as realistic as possible. So the basic strategy ends up in and I'm just testing 2022 over this period. So I put the start date and no end date. So it will use all the data it has to the end of 2022. And so this strategy has a net profit of 189% based on 2022 trading and these parameters. And it has a 6.9% drawdown. And you may not be able to read it, but it has a 58.9% win rate. So let's say we tweak that strategy to be a 1.5x net stop. So the stop is 2.5 times the initial credit for a 1.5 net loss. And the other strategy made 189% profit. This one made 119% profit. So it's basically like 75% of the profit, and the drawdown is a little bit greater, maybe 10% greater, not too bad. The win rate did go up 66% versus 58% for the past strategy. And then let's see if we increase it again, what will happen, and look at that. So again, the only parameter that changes is the stop. So this is using the 2x net stop. The stop is actually 3 times the initial credit for a 2x net loss. And the profit on this one is 1.8% profit. Still a darn good profit. But the drawdown, because you're using a higher stop multiple, is about twice what it is using a 1x stop, net stop. So be aware of that. You can, and the win rate is 71%. So yes, your win rate's going up, but your overall profit is going down because of the bigger losses. So that's a good reason to backtest. You wouldn't intuitively think that, but just from backtesting it shows you something about the trade. So now let's look at the credit targets. And you might think that if you reduce the size of the credit target, you'll be further away from the money, and the percentage of wins will increase, and you'll improve returns. And conversely, you might think if you increase the size of the credit target, it may help the profitability trade. I don't know which is going to happen. Just, it's just best to backtest and see what's true. I get these kind of questions a lot in the Facebook group, like, can I trade and reduce my credit size to 50 cents or increase my stop to a 2x stop? I'm getting stopped out all the time. So can I tweak those? And so this is to answer those kinds of questions or show you how to answer those for yourself. So here, this is the same basic strategy with the 1x net stop, 2 times the initial credit, $1.25 minimum credit on each side, 25 wide wings, and entering 6 times, entering at the same time. So the times didn't change, the stop didn't change. All we're doing is changing the credit on these various tests. So again, the win rate, it's hard to see, 58.9%. The profit is 189% profit. and the drawdown is 6.9% drawdown. So what happens if we reduce that credit to 80-cent credit instead of $1.25? Then our win rate goes up a little bit, 60%, it's like 2 percentage points, not a whole lot. But our profit goes down a lot. So we've got 80%, 87% profit versus 189% profit. So and the drawdown did get less, so 3.5% drawdown. Now, what you might want to do to offset that is if you're taking in less credit, you might want to increase the number of contracts you're doing to counteract the reduced credit you're getting. That's one way to do it, if you have the buying power to do that, because your buying power is going to govern how many contracts you can do in your account. But just something to think about to counteract the reduction in profit. And then if we increase the credit to $2 credit on each side, then our win rate is about the same as it was for $1.25 minimum credit of 58.3%. We've got about twice the drawdown as we had because of that larger credit. But look at that profit, 830% profit. So there's a very easy way to increase your profitability, is just target higher credits. Now, I will say, if you start looking at where you can get a $2 credit minimum, you're starting to be, within 10 points of the money. And so be aware that there's, it does have the same win rate, but it's awfully hard for me to trade that close to the money. And often you're going to be trading delta 20, 25 trades, which is closer to the money, and you collect more. Now, what helps this trade, I believe, is that additional credit somehow seems to you don't stop out as quickly. Note that the win rate really didn't change that much from the $1.25 credit. So it could be that these trades just stop out a little bit less. When they do, you're going to have a larger drawdown, but you're also going to make more money overall in the trade. It's your decision. So you get to decide. You don't have to copy what I'm doing. I'm doing what I do because I don't want the larger drawdowns. I like a low drawdown and a reasonable profit. I mean, 189% profit in backtest is great. Now, live trading, it may not achieve that. We'll talk about that in a minute. And then one other thing to look at is entry times. In the past, we've entered early to be able to capture a higher premium. My old 0 DTE Delta 5 was enter as soon as you can because the premiums are higher near the open. So let's say in this multiple tranches, we're not going to enter all our trades at once on this strategy. We're going to spread them out. And hopefully some of them will win, some of them will lost, but most of the time, not all of them will stop out. Compared to my old strategy where you'd enter, all of your contracts in the morning and just keep your fingers crossed on that trade, and you might get them all stopped out. It's kind of all in. You either win or lose on that trade, and it's binary. With this multiple entry, it's not necessarily binary. You've got a shot at some of them winning and some of them possibly losing. And so you're spreading your risk around, which is a great thing about this strategy. So this entry time is what is the original strategy that I've backtest, starting at 12 Eastern time and entering 6 tranches. And that strategy, again, had a 189% profit in 2022 and a 6.9% drawdown. So if we tried different entry times, and let's say we enter 6 tranches starting at 10 o'clock, entering through 12:30, then our profit has basically halved again. So we got a little larger drawdown, not too much more. And the win rate it's roughly the same, 57.4, and I think the other one was 58.9, not too different, but half of the profit just it, going for the same credit, $1.25 credit, just using different entry times, completely different profit. Now, if I enter starting at 1:30 Eastern time, so 1:30 and enter every 15 minutes because it's late in the day. I don't have much time to enter my 6 tranches. So I'm entering 13:30 on the 13:45 or 1:45, 2, 2:15, 2:30, and 2:45. Same basic strategy, still $1.25 credit, still 25 wide wings, entering 6 tranches. So what's going to happen? And I've made about twice the amount of money that I had made in the original strategy. And my drawdown wasn't, it was a little bit higher. The other one was 6 something percent. This is 9.6%. So about 50% higher, but still not bad for a whole lot more profit. So right now in the market, these later in the day trades are working really well. So as you can see from the profitability. Now, if you combine this with the higher credit, you get a fantastic return, like in the 800%. But again, I find it difficult to trade. Also, as you're entering these later entry times, you're going to be closer to the money when you're entering. So be aware of that. And I find that difficult to do. So there is an emotional component to this, or can I physically, can I enter this trade? And I just find it difficult to do. So I'd rather choose a middle of the road strategy that works reasonably well. And it works reasonably well in all markets, not just 2022, if you do some back testing. But right now, later in the day is working better. So it's your decision when you want to enter. So understanding back tests, these are just several back tests that I've done to show you the different, usually I try to change only one parameter in the back test at a time. And so I see exactly what changed. And I find something that works good. I change one parameter and then change one parameter again, see what the difference is, and compare results and make a decision based on that. So back testing, of course, is looking at what happens in the past based on a certain set of rules. It doesn't mean you can or should expect this performance in the future. Results in actual trading may vary from the back testing results because the back test is using 1 minute data, and that interval may not capture some stops, as I talked about before. I think that it's going to be close, but as I showed, for about every 12 trades, you can expect an additional half a stop that didn't show up in the back test. And so the performance is generally going to be a little worse in live trading compared to back tested trading. And then, as I said, there's a psychological component to trading. Like, I just have a very difficult time trading, Delta 25, Delta 30, Delta 40 trades because I feel like I'm going to get whacked. So I just can't enter them. But trading with a set of rules and a known result helps mitigate those emotions. We're all human. Emotions are going to influence our trades, but by using a set of rules, we can help overcome those emotions and know that, okay, yes, I may be afraid, but do it anyway because I see that it works out so well from the back test. And then as I trade it in live trading, I gain more confidence in the trade. So that's why I would personally never recommend something to you guys that I have not back tested myself. So in my results, how do live trading results compare to the back testing results? Back testing is based on 1 minute data. It will miss an additional stop. Based on my results from August 16th to December 30th, here are the exact numbers, 59% winners. And out of every 12 trades, which means a trading day, essentially, 4.92 were losers. And so I've got converse of that would be winners. In live trading, 53% were winners, and I had 5.64% losers out of every 12 trades. The back test shows 100% return on buying power over that period of time. And if you just look from August to December, and I know what we were looking at was January to December, but if you just look at August to December, it's roughly 100% return on buying power. And I had about a 58% return on buying power in live trading, which is still very good. And I made up those losses that I had in early January, trading this from August to December. And you still have positive expectancy, even with 5.64% of losers out of 12 trades. You'd have to have six losers out of every 12 trades just to have a break-even strategy, or 7 losers out of every 12 to have a losing strategy over a long period of time. So this back test very well. I would say in general, just back test and develop the parameters to get the best results you can that you are willing and able to trade. And then always go back and once you've live traded that for a while, go back and compare your live results, back test that same period and compare and see how you're doing. Now, I will say from August to December, when I started out, the first month and a half, I was not entering a full 6 tranches. I was entering part of the tranches. I was experimenting a little bit. I was sometimes not going for $1.25 minimum. Sometimes I was going for less. Rarely was I going for more than $2. But even with all that messy trading, I was able to achieve a 58% return on buying power, which is great. So your live trading results will be somewhat worse, but hopefully not even as worse as these were, because I was trading pretty erratically. And then you're probably wondering about where you can get this back tester. The interesting thing that's happened with all the increase in zero DTE trading is there have been several individuals, I'll say, not even companies, but individuals who have developed back testers who had programming skills and decided to purchase the CBOE data for themselves so they could test and build their own back tester, because there just was nothing available on the commercial market for testing zero DTE trades. So this back tester that I've used here is called Build Your Own Back Test. You set the parameters, and it is free currently. And it is true automated back test. It just takes a few seconds to run, if even that, to run a year's worth of data. It takes about 30 seconds to run 6 years, which I think is about the most data it has. It has to back to 2016, so 6 years of data. 30 seconds to run that. So it's very quick. And it's using 1-minute intervals on SPX. You can use, I will say, TOS on demand uses tick data, so you can get much more fine-tuned data, but I've heard there's issues with TOS on demand in the reliability. It's not automated. You have to step through the ticks and see how the trade did, and it's tedious. So this gives you a rough idea of how a trade will do for free. And it has an excellent trade analysis summary. You could see the kinds of results we were seeing. Go back and look at the slides when you have time. Email me and I can send you a copy of the presentation, and you can see these slides for yourself and read the numbers a little bit better. And so you can change, you can enter by credit target or delta. You can determine a fixed number of contracts or by percent of buying power per entry. Now, it looks at individual trades. So when you enter a percent of buying power, if you say use 50% of my buying power, and then you select 6 different times to enter, that means it's going to be using 50% of your buying power at each of those times. So you have, what I do is I set it for 8, which 6 times 8 is 48. It's roughly 48% of my buying power in a back test. So rather than setting the percent of buying power at 50, I set it for 8% because it's per trade or per entry. You can test out various stop multiples from no stop to, I think, a 4 or 5x stop, and you can use profit target if you want. I tell you, I didn't go into that, but the profit targets just don't help this trade. And then you can enter. The nice thing about this back tester is the multiple entries. You can enter multiple times a day without having to rerun the test on each time. In another back tester I'll show you, you can only run one time at a back test. So you'd have to run a back test on 12 o'clock and a back test on 12:30 and a back test on 1 to see how the performances change and then combine results. And then you can also review individual trades on this build your own back test. So that's another advantage. Then another back tester that's commercially available and is a lot more robust, I'll say, is optionomega.com. It costs about $99 a month or $600 a year. I provided a link here you can use to get 50% off, and I believe that 50% off is applicable for as long as you maintain your subscription. So you can get that 50% off. So 1 year at $300, 12 months for $300 is a great deal. And it makes it about $25 a month. And it, again, is true backtesting software. You're not entering trade by trade and stepping through to see how it does. It is automated. So you set up the parameters, you run it, and it chugs for a few seconds and it comes up with the results. Option Omega, the build your own backtest only works on SPX. It's the only data it has. Option Omega has data on SPX, SPY, IWM, and QQQ. So it's more versatile, and you can test out, if you want to trade SPY, how does that do with this strategy? It has data on 1-minute intervals for these symbols. It also has excellent risk graph or risk graph and graphs and result graphs and trade analysis tools. And with this, you can trade many different strategies. You're not limited to iron condors or credit spreads as you are with build your own backtest. So if you want to do kind of develop your own, you could develop your own strategy here, calendars, whatever. It has some preset trades that you can select from, but you can combine trades as well. You can review individual trade results, and you can combine results or group results in portfolios for analysis. Now, one caveat that I've learned about this strategy is because it's using 1-minute data, if you've got to select this option. Once you set a stop, there's an option that pops up that says cap non-opening losses at the stop loss. If you don't do that, what it does is it takes whenever the price exceeds your stop, it takes the data at the next 1-minute interval and applies that. So 1 minute is a long time when a stock is tanking and your stop loss is hit, as you know. So you could end up with a much larger loss, and it skews the data. So I'd always recommend just capping the non-opening losses at the stop loss. And that way, now in live trading, you might get a little bit worse performance because that sometimes you don't get out right at a 1x loss or a 2x loss. It's 1.3 or 1.2 or 2.5x loss. But this will get you close. And so it's a great back tester. And these guys that developed it did a really good job. So kudos to them. Then there's always OptionNet Explorer. If you want to step through trades, it uses 5-minute data. 1 month free trial is available in OptionNet Explorer. It costs about $60 a month. it is not a true backtesting software. It has historic data. You use that historic data in an option chain to select a trade, then you step through it to see how it performed. And it has intraday data where most backtesting programs don't, and it was the only one available for a while. It does have the Greeks for intraday data. So I'll often, when I'm first working on a strategy, I'll often go to OptionNet Explorer and test it out and just see how it behaves. I get the best feel for how a trade is going to behave while it's on by using OptionNet Explorer. So it's a great use for that. And I still recommend it. So if you have questions, feel free to contact me at my email address here. And I'm available also on Facebook group, the Tasty Trade Options Facebook group. There's the URL for that, and that will take you to, if you're not already a member, you can answer a few questions and join the group. If you try and get rejected, just email me and I'll help you get in. We ask questions to try to keep a lot of the spammers out. So we're pretty particular in what we're looking for. If you created your Facebook page, if you just joined Facebook yesterday and you try to join our group, it's likely not to let you in. Automatically will kick you out. So just email me if you have any trouble. This is a great place to see what strategies are working for traders. A lot of us post our trade results for the day. I don't post what I'm trading as I'm trading because it just gets too hectic during the trading day to do that. But I have been posting my results since the first of the year, and you can see my results every trading day. I'll post those. And there are quite a few people in that group who trade zero DTE options, even though it's called Tasty Trade Options. We've thought about changing the name, but so many people know that group that we've decided it's almost a brand for us. And but we all trades are welcome, not just zero DTE trades. So we're frequently posting about what's working and what's not. So you're welcome to join us there. And that's the end of the presentation. I will say, and I should have said at the beginning, this presentation is for informational purposes only, and it's not to be construed as investment advice. And any trades you make on this information are your responsibility alone. And I disclaim any liability, loss, or risk associated directly or indirectly from the use or application of the contents of this presentation. But you can email me and I'll help answer any questions you may have or help you out if something's going wrong, or if things are changing, I can let you know, and we'll let you know what the latest is. So anyway, thank you very much for attending. I appreciate it. And we will see you in the next video. Thanks.